What's good, my fellow stock market trader and investor homies? It's your boy Kevin. Welcome back to the channel. The stock market is testing those lows that we saw a couple weeks ago. Although we are green on the day, earlier this week, we had BlackRock, the world's largest investment fund, one of the world's largest hedge funds, came out and said that they're staying away from stocks altogether. They said that they're staying away from stocks like you should stay away from those sorority girls who got those STDs. Just stay away. Don't touch them. They're going to get you in trouble. Well, BlackRock came out and said, stay away. The stock market is not hit a bottom yet, and a bottom's not coming anytime soon. So we're going to dive into this announcement from this giant hedge fund and talk about it. Are they right? Is there a red flag? Should we be staying away from stocks? Should we be cost averaging in? Or should we just be trading in and out actively and lowering that risk profile? We're going to be breaking it all down in today's video, so you're going to want to stay tuned. All right, so BlackRock. We shun most stocks among unrealized recession risk. On Monday, strategist at BlackRock's Investment Institute said in a note that the firm was shunning most stocks as monetary policy makers underestimate the severity of a potential recession that could ensue from aggressive rate hikes. We know that the idiot that is running the Federal Reserve has been banging these rate hikes. Every other month we see a massive rate hike that we haven't seen. We haven't seen rate hikes like this in a long time, and it has shocked the economy into a recession. Many central banks, like the Fed, are still solely focused on pressure to quickly get core inflation back to 2%. Without fully acknowledging how much economic pain it will take in a world shaped by production constraints. A team led by Jean Bovian wrote in the note. So they're saying that the Fed is just only focused at getting inflation back to 2%, but they think that production constraints or supply chain constraints are one of the main causes of this inflation, and really raising the interest rates aren't going to affect the supply chain or production constraints, although I guess they would on the demand side. But I really don't think these interest rates are going to have the type of impact on this inflation that the Fed thinks it is. I think it's more so on the supply side than it is the demand side. When you shut down the economy, right, and people aren't working because the economy shut down due to the Rona pandemic, people still need to buy things. If things aren't getting made, you're going to have a shortage of those goods. And as the economy opens back up, that shortage should naturally kind of ease. But that's just my opinion. BlackRock's message comes amid a brutal rout in equity markets. We've seen this crash. It's been ugly over the last 3-4 weeks in equity markets that has all three major averages in bear market territory. As of Tuesday's close, the benchmark S&P 500 was 24% below its January all-time high, while the Dow is off those all-time highs by 21% over the same period, and the Nasdaq is down 33% since its November high. BlackRock strategists argue that recent inflationary pressures have been triggered by a structural shift in spending from services to goods, as well as production constraints caused by the pandemic, the war in Ukraine, and China's Rona lockdowns. Issues that cannot be resolved with monetary policy intervention. So the Fed is putting their thumb on the scale, although the Fed may not even be able to fix this issue with these rate hikes. Central banks can't fix these constraints in our view, hence a brutal trade-off. Trigger a deep recession by hiking rates or live with more persistent inflation. All right? So they're basically saying we're either going to continue to see inflation or the economy is going to spiral downward and we're going to see a massive recession. When we see a massive recession and the economy goes down and contracts, what happens to stocks? They go down, they contract. So I completely agree with BlackRock here. I agree with what they're saying 100%. Now, I don't always agree with what these big hedge funds do, but in this particular situation, I 100% agree with what they're saying. Jerome Powell is out of control. The Fed is out of control. These interest rate hikes haven't done shit. They haven't done shit to slow down inflation up to this point. Why? Because it's not really about the interest rates. Sure, it's good to be able to buy a house at 2.5%. It's good to be able to buy a car with a cheap loan. But what's really happening here is on the supply side. It's due to the fact that we're seeing the war in Russia, the war in Ukraine, oil prices skyrocket due to the fact that China shut down and we basically buy everything from China, and it's hard to get those cheap Chinese-made products right now. All right, so what do we do? What do we do? Do we stay away from the stock market altogether, or do we cost average in, continue to buy? What the hell do we do? Well, I'm not buying right now. I'm going to be honest with you guys. I have a YouTube channel that only gets views when I make videos about stocks. I'm not buying long term right now. However, I am trading, and I want to talk to you guys about a strategy that I've been using that is very effective in markets like this. It can profit whether the market rebounds and goes up, or it can profit if the market continues to go down, and it can also profit if the market just chops around. It's an option trading strategy, and it is called using an iron condor. I've talked about it on the channel a lot. It's an extremely powerful strategy. It works very well. Limited risk, you can limit that risk, and it has tons of upside. So in a very basic explanation, a very basic definition of an iron condor, what you do is you sell one put, right? You're going to sell a put. Let's use the SPY, for example, the SPYs. We're going to sell one put right here. Let's say we think the market is going to continue to slowly go down, maybe chop around a bit like this, do one of these, and work its way lower. What I would do is I would sell some puts right here. Let's say we think the market's going to go down a little bit but stay above 340. So we sell puts at 340 for some protection. We're going to buy some puts at 330. We're also going to sell some calls, let's say up at 382. And then for protection, we're going to buy some calls at 390. This is just a very basic example. I don't have this trade on that I just talked about. I'm just using these numbers as purely an example. I'm not saying to go out and put this trade on yourself. So basically what you've done here is you've taken in a credit for selling this put that is going to be greater than the cost of buying this put. You've also taken in a credit for selling this call that's going to be greater than the cost of buying the call for protection. So let's say it cost you $1 to sell this put or buy this put down here for your protection, but you took in $2 of credit right here for selling the put. So you have a $1 credit here on the puts. Let's say it cost the same situation for the calls. So you took in a $1 credit for the calls. So right now you're sitting on a $2 credit. You have $2 in credit that you took in for putting on this trade. Let's say the market does one of these, and by the time of expiration, the market is in this window. As long as the market is in this window from 390 to 340, you keep this credit after these contracts expire. So you're basically becoming the casino. Let other people speculate where this market's gonna go, because we really don't have any clue, right? The Federal Reserve doesn't know what the hell they're doing. Jerome Powell has no idea what he's doing. And I'm not going to bank. I'm not going to put my money in a market that is solely dependent on one man, and that is Jerome Powell, and how he feels that the market is doing. If he says, I need to raise rates another 20%, he could do so, and he could lean on the Fed to do that. Biden does not want to see these headlines about inflation going into this midterm. He doesn't want to hear any more about inflation. I've been saying this. So he's putting his foot on the brake and saying, I don't care really what the economy does as long as CNN, Fox News, CNBC stop talking about inflation. So he's leaning on Jerome Powell and the Federal Reserve to continue to raise interest rates and get this inflation under control, even though these interest rates aren't going to have the impact on inflation that they think it will. You know, you had the Trump administration leaning on the Federal Reserve to keep interest rates low so the economy would thrive. And now we have this new administration, or not necessarily new anymore, the Biden administration leaning on the Federal Reserve to raise interest rates. So I'm using this strategy to get, it's kind of a neutral strategy. We don't care if the market goes up. We don't care if it goes sideways. We don't care if it goes down. But as long as it stays in that window of the call that you sold and the put that you sold, you reap the profits. So if you like, right, I'm not telling you to stop buying stocks, to stop cost averaging in if you really like a long-term play. I'm still looking at some stocks to buy long term. I do, however, think we go lower, so I'm trying to hold off as long as possible. Then I'm going to start buying. I do think we break this level here. I'm almost positive this is not the low, right? This support area, I think we come through that area. And once we do that, maybe I'll start to acquire. But this isn't ending tomorrow. This is not ending tomorrow. This is going to be a long, played out thing that can literally take 15 to 24 months to resolve. It's going to take a long time for the market to get back up to those all-time highs. It's not happening next month. It's not happening probably next year. It's going to take a while. And I know a lot of you guys probably don't want to hear that coming from me as you subscribe to a channel looking to make money from the stock market. But we're still going to be making money. We're still going to be putting on trades. And I just want to be honest with you guys. I feel like transparency is always the best policy. Right now, I think BlackRock was 100% accurate, and the Fed is really messing up this economy when they don't need to. They're not going to be able to get this inflation under control, raising interest rates, because people still need to buy food. They still need to buy gas, no matter how much it costs to get a loan at the bank. I love all you guys. Let me know what you think in the comments. Is the market gonna free fall? Have we seen the lows, or should we be buying this dip, getting ready for the rebound? I love you guys, and I'll catch you in the next video.